Of all the questions you could be asking a potential seller when you're looking to buy a business, here are the top 5 most important questions you should be asking. Let's get to it. Everybody, welcome to my channel. I am your host, Leo Landaverde, business broker and commercial lender, helping you buy and scale a profitable business. If you are a small business owner looking to increase and diversify your wealth by buying a profitable business, or a W-2 employee sick and tired of the rat race, wanting to leave the rat race behind by purchasing a profitable business, you are in the right place. Please subscribe to my channel. Don't forget to hit the bell, and you'll be notified every Thursday when new videos come out. All right, let's talk about the 5 questions. Now, they're not necessarily in any order of importance. They're just important questions that you should be asking the seller. Number 1, is the seller flexible? Now, what I mean by that is you're going to be running into some sellers that they'll tell you, this is the price of my business and I will not take a penny less. For whatever reason, there is no flexibility on the seller side. And you know what? That's going to set you up for failure. Because I guarantee you that whatever price the seller has in mind may not be the price that the offer that you're gonna make for many reasons. There may be lack of financials. There may be a necessity. It would be necessary to get the seller to carry some of the paper because of the justification that there will not be enough cash flow. Just there's a lot of unknowns. And I always like to know, when representing the buyers and when working with buyers, or even me when I'm looking for a business, how flexible is the seller. Now, there should be some sort of a variability to the purchase price. So say, for instance, that the owner has the business listed for sale at $1 million. However they got to the million offering price, we don't know. That's not necessarily our thing to figure out. They have a number there that is listed for in Biz Buy Sell or wherever else. Our job is to figure out if we can actually justify the $1 million. So that $1 million may end up being $800,000, or it could be $1.2 million. I have also seen businesses that actually go higher than offering price and the purchase price if it's a really, really good deal and it's priced correctly. So if the seller is not flexible, then you have a problem. So question number 2. Is there any customer concentration? So one thing you have to keep in mind is that no matter how good the business looks and the cash flow is great and all of that stuff, if you have one customer that has over 10% of all the revenue for the year, that customer goes away, you're in trouble. Let me give you an example. Say you have a purchase price of $1 million with 10 customers, each one that represents 10%. For instance, one of them walks away and you have a 10% bottom line. That 10% bottom line is gone because you have nine customers on $900,000. Your $100,000 10% profit, it's gone. So now you're breaking even, and you still have to come up with a debt service. So you will be upside down on the debt service if one customer walks away. What you really want to know is that there are plenty of customers. The more customers, the better. And you have any of them walks away anytime, you have no issues. The amount of net income that you would lose, the amount of revenue, gross profit, it would be negligible. So any educated buyer would want to see through the list of all the customers during the diligence and run their own calculations that year over year, month over month, there is not one customer that dominates at all. That customer walks away, then you're in trouble. But with that said, that doesn't mean that if you have a customer concentration of 15%, it may not be the thing you walk away from. So let me give you an example. A business has been around for 40 years, okay? With one customer, business that is doing, say, $1 million in revenue a year, and it has one customer that does $150,000 worth of revenue per year. But that customer has been around for 30 years. I'm just keeping the math simple. Been around for 30 years. They're in a 5-year, multi-year agreement. They renew every 5 years. They love what they do. We do hardly any work. It's a great legacy customer. So then I would consider, wait a minute, what is the likelihood of this customer sticking around for another 30 years? Just think about it that way. If this is a corporate customer with AAA credit that is being part of the business, 15%, I would consider. Perhaps what I would do is I would hedge my bets and offer a little less as a way to protect yourself in case that customer walks away. There's ways that you can structure the deal in a way to, for instance, one of the things you could do is, say you want to make the give full price, you really like the deal, assuming everything else makes sense to you, you can have a seller carry portion for the 15% that representing that customer with some clawback provisions to protect yourself in case the customer walks away. There's many ways to do that, but customer concentration is something you should be really aware of. Okay, are you stuck and trying to figure out how to do this thing about buying a business? Do you know what the ideal purchase price is? What if you don't have tax returns? When do you bring the lender? Should you be pre-qualified before you talk to the seller? How much money do you have to put down? Do you need working capital? And many other questions I am sure you're asking yourself. We should probably connect. I would love to know where you are in your acquisition journey and see if it would make sense for us to get together and work with each other. Feel free to reach out to me. We can set up a free complimentary call. I just need to ask you a few questions. Drop me a comment below or connect with me via email. My email address will be in the description section of this video and actually up here, and so you can see it along the screen. Let's do it. That is 2 questions. So question number 3, is there a management in place? Now, what is it that we ultimately want, right? If you're an employee who is looking to leave the rat race behind, the last thing you want is to buy yourself a job. You're not buying yourself a job. What you really want is buy a business with a management team in place. If you have a seasoned business, you're probably not going to find that at a business that is doing $1 million a year in revenue. You're probably going to be in a business that is doing $2 to $3 million that has, in revenue, annualized revenue, with about 10 to 20 employees. Maybe 3 or 4 are key employees. You have an operations manager, a sales manager, a marketing manager, and maybe somebody else, a project manager. And they actually run the day-to-day operations, and you're able to work part-time being the CEO because you're the investor. You are the CEO. And you're worried about trying to figure out how to double the size of the business, but you have a management team in place, it's gonna make your life ultimately easier. And businesses that have a management team in place are always bought at a higher valuation because what you're actually inheriting when you buy the business is human assets. You heard me right. Those employees could be assets or liabilities. But these key employees who've been around for a long time, they actually have become assets for the business with institutional knowledge that you need to grow the business. And it behooves you to have them stick around. What I see that a lot of the lenders really wanting the buyers to do, because the lenders are on your side, they want to make sure that not only are they hedging themselves against the risk, but they're setting you up for success. It's not uncommon for either I as a broker or an advisor or a lender to suggest to the buyer, look, those 2 employees are key employees. You need to get them under a management agreement. And we want to need that management or some type of employment agreement in place that is going to keep them captive for at least 2 to 3 years when you buy the business. So they're forced to stick around. And then you sweeten up the pie by offering some incentives for them to stick around. You earn their trust and they'll stay with you during the transition. Next question. Is the seller open to financing portion of the deal? Now, with interest rates where they are today, in a climbing interest rate environment, now what I've seen a lot of lenders do is they're cutting back on their exposure. So when 2 years ago it would have been a 90% loan to value, you put 10%, the bank puts 90%, seller walks away with all cash, with no skin in the game anymore. Well, what I'm seeing now is the lender will say, I'll give you 75 to 85%, and then they want the seller to carry 5 to 10%, and they want the buyer to come up with 10%. Why are they doing that? As a way to have the sellers have some skin in the game, and with some type of clawback provisions that if the business doesn't perform, it's gonna hurt their loan against the business regardless of whatever UCC filing they have. So now, the way you actually want to position yourself, you have to assume from the get-go that the seller is going to want to carry some. Now, if a seller is represented by a very good, knowledgeable broker, and then the seller wants asking price on the deal, they say, I want the asking price, and basically they come out swinging with a very high valuation. And In order for them to get the valuation, the only way it would make sense is if they actually carry some of that exposure, carry some of the upside in the terms of a seller note, or they may even stay as a minority shareholder, except that you have a trigger. Now, if a seller is going to stay on as a minority shareholder in the new code that you're going to establish when you buy the business, if they own 20% or more, they're going to have to guarantee the loan, and no seller is going to do that in their right mind. So you would have to, line up the cap deck in a way that the seller has less than 20% of the new co if they're going to stay, or you have some clawback provisions. Either way, now seller financing is here to stay. It is actually a great tool for the buyer. It works for the buyer, not for the seller. And last but not least, number 5 is, are tax returns available? I am shocked as to how many businesses are coming out to market with no tax returns. So, and not only do they have tax, if they don't have tax returns, chances are the business has to be SBA pre-qualified. Now, why would you put a business on the market with no tax returns and not pre-qualify for an SBA loan? You as a seller are setting yourself up for failure. Now, what you're assuming is that a buyer is going to become a cash buyer, and they're going to write a check out of their checking account to give you the asking price of the business that is probably overpriced. So, if you do not have all the preceding year tax returns, I want 20, 21, 22, all filed and part of the confidential information memorandum. If you don't have that, you shouldn't put the business for sale. Now, if you have the business for sale and you have the tax returns, I don't mind as a business broker sharing some of the tax returns with a very sophisticated buyer that I think is going to be able to close the deal. But my job is to screen the buyers in and out of the transaction. So tax returns are key. There is no way you're going to get funding from a respectable bank or from any bank unless you have tax returns for all the years except the interim fiscal year. Guys, those are the 5 questions you should be asking a seller when trying to buy a business. Hit me for some questions, make comments, let me know what you think. For a limited time, I'm giving away my cash flow calculator book, which is a tool that you're gonna need to go from analyzing the deal to figure out how much loan you're gonna need and everything else with over 100 formulas. It's my gift to you to help you in your buying acquisition journey. And I'm also giving away my buyer's checklist, which is 5 pages of all the documents that you're gonna need to put a deal together. Those are my gifts to you from subscribing to my channel. Please click on the links below and they'll be yours to have.